Hello, and welcome to our discussion on leases. In this vignette, we will discuss the topic of lease accounting, as well as do some examples together to solidify our understanding. Firms can choose to lease assets as an alternative to purchasing them outright with cash because it allows them a flexibility in their strategic capital use. The accounting for leases will depend on the intended usage of the asset by management. We will cover two main types of leases in this vignette: operating leases and finance leases. In general, a lease is a contract between the owner of an asset, a lessor, and a party desiring to use that asset, the lessee. Some common lease provisions include that the lessee has an unrestricted right to use the asset during the agreed upon lease term. The lessee also agrees to make periodic payments to the lessor and maintain the asset in good working condition. Also, the lessor retains title of the leased asset during the leasehold period. From the perspective of the lessor receives an acceptable return on the investment. This is going to be included as a part of the lease payment. In addition, the lessor should investigate the credit standing of the lessee to make sure that that return is viable. From the lessee's perspective, the lessee will gain the use of the asset, and they do this because they often have a lower commitment versus purchasing that asset outright with cash. When we're thinking about the accounting for leases, we are going to take the lessee's perspective. We will not be discussing the lessor's perspective in this vignette or in class. From the lessee's perspective, the FASB has specified two different types of classifications. One are finance leases, the other are operating leases. For both finance and operating leases, a firm is required to record an asset and a liability on the financial statements. There's an exception to this, and that exception is for leases that have a life less than 12 months. Between finance leases and operating leases, the financial statement effects will differ, and we will cover them via examples. For operating leases, the right to use asset and lease liability are reported on the balance sheet. The lease expense is related to the cash that is paid in each period. We will not separately record an interest expense or amortization expense on the income statement, just the lease expense. When treating a finance lease, we will also record a right to use asset and a lease liability on the balance sheet. However, in this situation, we will have the asset be amortized and the lease liability be amortized. For lease liabilities, we will split out the amortization between interest and principal payments, as well as an interest expense that will be recorded on the income statement. When trying to determine the difference between a finance lease and an operating lease and understanding how they should be recorded on the balance sheet, we use one of 5 criteria to classify a lease. If a lease meets at least one of these classifications, it must be classified as a finance lease. The first is ownership transfer. If the lease specifies that the ownership of the asset is given to the lessee at the end of the lease, it must be a finance lease. The other is purchase option. A purchase option is where a lease grants the lessee the ability to purchase the asset, and that is expected to be reasonably exercised by the lessee. If that occurs, that must be a finance lease. 3, the lease term length. If the lease term exceeds 75% of the economic life of the lease, it is a finance lease. 4, if the present value of lease payments is greater than 90% of the asset's fair value at the time of signing of the lease, it's a finance lease. 5, the alternative use. If the asset has no alternative use to the lessor at the end of the period, you got it, it's going to be a finance lease. Let's set up a lease example, and we'll cover the two different types of treatments. Let's say that Phelps Swimming enters into a lease contract for a truck in a 5-year term with annual payments of $3,256 based off of an 8% interest rates with payments due at the end of each year. Under both finance and operating leases, we will use the present value of lease payments, here $13,000, as a way to record the initial asset and liability. Let's first focus on finance leases and record that initial lease liability and asset. Again, Phelps Swimming leases a truck with a 5-year term, annual payments of $3,256 due at the end of each year, with an 8% interest rate and a present value of $13,000. We will first record a right-to-use asset of $13,000 and a finance lease liability of $13,000. Notice that there is no income statement impact at the initial recording of the lease. When thinking about how to record the year 1 payment for a finance lease, we must do this in 2 parts. The first part is that we must amortize the lease asset over the lease term. We will do a straight line amortization over the asset's life of 5 years. In addition, we must reduce the lease liability over the lease term, and that will be based off the interest expense and principal repayment from the cash that was paid to the lessor. Let's look at the recording of the amortization of the lease asset first. We can calculate the amortization of the lease asset by taking what's on the balance sheet, the right-to-use asset, dividing it by the leasehold period, 5 years, and get the amortization expense for this period. That will be $2,600. $13,000 that was on the balance sheet divided by 5, $2,600. We will record this in a contra asset account called accumulated amortization of the right-to-use asset. Here, we will record an income statement impact related to the amortization expense that will directly affect net income for $2,600. For the second part, considering the effects of the lease liability, there will be 2 components. The first is the interest expense, and the second is the principal repayment. Again, notice in year 1, we began the period with a $13,000 lease liability. We record the interest expense by taking the opening balance of lease liability, multiplying it by the interest rate, 8%, to get the interest expense. That interest expense here is $1,040. We paid them $3,256 in cash as agreed upon in the lease. The principal repayment will then be the difference between the cash that's paid, $3,256, and the interest expense that we calculated, $1,040. The ending lease liability will be the difference between the beginning balance and the principal that's repaid. That will get us our lease liability net. When recording this in our accounting statements, notice that we start with the interest expense that we calculated. This will be a reduction in equity for $1,040 of 8% times the beginning balance lease liability. This is going to impact the income statement for $1,040 in expenses, directly affecting net income. In addition, we already know that we paid cash of $3,256. It was specified in the contract. To get the amortization of the lease liability, we simply take the cash that was paid to the lessor and remove from it the interest expense to get the principal that was paid back to the lessor. That amount is $2,216. When thinking about an operating lease as opposed to a finance lease, the initial recording of the lease asset and liability are equivalent. However, there will be a difference in the accounting subsequent to the initial measurement. We will record an equal amount of expense in each period on the income statement. And the total expense will be called lease expense. That's going to equal cash paid. We are not going to separate the amortization expense and the interest expense that we just did in finance leases. The lease asset and the lease liability will be equivalently amortized based off of imputed interest. However, firms may elect to amortize the asset and liability at different rates, a topic that we are not going to cover in the vignette. For an operating lease, Phelps Swimming, again, leased a truck from Ryder Trucks with a 5-year lease, annual payments of $3,256 due at the end of each period, based off an 8% interest rate with a present value of $13,000. Same situation as we had for the finance lease. However, under operating lease treatment, there will be some differences. With the recording of the initial asset and liability, there is no difference yet. We will have a $13,000 right-of-use asset and a $13,000 operating lease liability. Again, no impact on the income statement yet. Let's first record the lease expense. As mentioned previously, the total cash paid will be the total lease expense. We are not going to separate out interest and amortization expenses. From here, we will have a reduction in the contra asset and the lease liability for the amortized amount of the lease. How do we calculate that? First, we need the implicit interest rate. The implicit interest that is due on this leased asset is going to be 8% times the beginning balance of lease liability, $13,000, to get us an implicit interest expense of $1,040. From here, we look at the total lease expense from the previous slide. That was $3,256. From that, we remove the implicit interest expense of $1,040. This implies an amortization that we must reduce both the asset and the liability by $2,216. There will be no effect on the income statement for this. There is only an effect on the income statement for $3,256 related to the lease expense. When comparing the expenses under each lease method, notice that for a finance lease, we have two components. For the operating lease, we have one component, as shown by the examples done previously. For a finance lease, we must add up the interest expense as well as the amortization expense. In year one, the example that we did, a finance lease had an interest expense of $1,040 and an amortization expense of $2,600, leading to a total expense related to leases of $3,640. When you compare this to the operating lease expense, the lease expense there was just the cash paid, $3,256. Notice that at the end of the leasehold life of 5 years, both expenses are equivalent. However, in earlier years, operating leases have lower expenses, which maintain stable throughout the leasehold period. The expenses, however, on finance leases start high and end low. So earlier in the life of a lease, finance leases are slightly more expensive. However, later in the life of finance leases, they're less expensive than operating treatment. This concludes the vignette. Thank you.